Bismillahirrahmanirrahim. Dear students, Assalamu alaikum and welcome back in lecture number 28. Let's have a look into the summary of our previous lecture. We covered the following topics in our previous lecture, that is the value creation and key sources of value creation for the firm, and overall cost of capital of the firm, where we calculate the cost related to different portions of the financing, that is debt, equity, and the cost of the individual components of the firm's cost of capital, that is cost of debt, cost of preferred stock, and cost of equity or the common stock, and the alternate models to determine the cost of equity, including the dividend discount approach, the capital asset pricing model approach, and the before tax cost of debt plus risk premium approach. And now we will be discussing the second part of the chapter number 15 about the required returns and the cost of capital. Now I will repeat the learning outcomes. They were repeated in the previous lecture as well. So just to remind you that what are the learning outcomes of this chapter, that after studying this chapter, you will be able to explain how a firm creates value and identify the key sources of value creation. And you should be able to define the overall cost of capital of the firm and calculate the cost of the individual components of the firm's cost of capital, that is cost of debt, cost of preferred stock, and cost of equity. And you should be able to explain and use alternative models to determine the cost of equity, including the dividend discount approach, the capital asset pricing model approach, and the before tax cost of debt plus risk premium approach. And you will be able to calculate the firm's weighted average cost of capital and understand its rationale, use, and limitations. And also you should be able to explain how the concept of economic value added is related to value creation and firm's cost of capital. And you will be able to understand the capital asset pricing model's role in computing project specific and group specific rates of return. And let me first remind you that what is the concept of weight in total financing from the different sources of financing. For example, if you look in this table, the debt in the total capital structure of the firm is $30 million, and preferred stock is $10 million, and common stock is $60 million. And out of the total capital, the debt is 30%, preferred stock is 10%, and the common stock is 60%. So you can see here, you can make this calculation. It's very simple. That is, total capital is $100 million, and 30% we calculated $30 million out of $100 million into percentage, that is 30%. And like that we can calculate the weightage of each type of financing in the total capital structure. So this is 10% and this is 60%. And how do we assign cost to each proportion of capital, that is to debt, to preferred stock, and the common stock? So if you look into this portion, this is the cost of debt, that is how much interest is being paid on the borrowed debt, that is long-term debt. And then the preferred stock, how much dividend is being paid to the preferred stockholders. And then the common stock equity, that how much cost is being paid, it is representing the dividends paid to the common stockholders. And now we have the proportion of all these financing in the total capital structure, that is we calculated in a previous slide, that is 30%, 10%, and 60%. And now we assign the cost to the weightage and we calculate the weighted cost of the capital. So you can see here, we multiply the cost to the proportion of the financing in the total financing. We get a weighted cost for debt equal to 1.98%. And then for the preferred stock, we get a weighted cost equal to 1.02%. And for the common stock equity, we have 8.4%. So this is the weighted cost of the individual proportions of the capital. And the total cost of the capital for the firm would become, if you add up all these three calculations, you will get 11.40%. So this is the total cost of capital for a firm. And what are the limitations of the weighted average cost of capital? First of all, the weighting system, that is the marginal cost of capital, and the capital raised in different proportions than the weighted average cost of capital. When we say marginal cost of capital, it means कि अगर फर्म ने फाइनेंसिंग अरेंज करनी है और फर्म का जो कैपिटल प्रोपोर्शन है, that is we calculated in previous slide 30% for the debt, 10% for the preferred stock and 60% for the common stock. But when the firm is going to arrange financing, the firm will be arranging financing in different proportions. Let's suppose out of debt firm arranges 60% and out of common stock firms arranges 40%. So in that case, the marginal cost of capital will be totally different here. So you can see for this, we suppose the cost of capital is 6.6%, and for this portion, the cost of capital as given in the previous slide, it is 14%. And if you calculate weighted average cost using this information, it will be much different from the weighted average cost of the capital for the firm, for the overall cost of capital of the firm. So the funds raised for the financing of the project, they are in different proportions and their marginal cost of capital will be different. And for the weighted average cost system to hold true, the new financing should be in the same proportion. That is, जो पर फर्म का proportion है इस वक्त 30% out of debt, 10% out of preferred stock and 60% out of common stock. A firm की cost of capital will be relevant only in the case where the proportion of the financing is in the same proportion as the firm has at the present time. And another limitation of weighted average cost of capital is that whenever you are going to raise any kind of financing, there is a flotation cost attached to it. So how do you handle the flotation cost? So flotation cost, in fact, they are the costs associated with the issuing securities such as underwriting, legal, listing and printing fees. So there are different costs which are associated while issuing or arranging financing for any project. So if the firm is going to issue some new stocks, so there will be the expenses paid to the underwriters, and then there might be some expenses paid to the lawyers, legal expenses and the printing fee, and there are so many types of expenses. So all that is known as flotation cost. So then this cost has to be adjusted when we are going to calculate the present value or the net present value of any project, and based on that information of net present value, we are going to accept or reject any particular project. So the flotation cost must be associated to some part of the calculation. So in this case, we have two arrangements. इसमें पहला arrangement है, that is adjustment to initial outlay and then adjustment to discount rate. And the adjustment to initial outlay means कि firm के जो all future cash flows हैं, we calculate the net present value by calculating the present value of all the future cash flows at the required rate of return, and then we minus the initial cash outflow, that is the investment, or we add the flotation cost in the initial cash outlay. So it means कि हमारी जो net present value है, that will be reduced by the flotation cost here. And in this case, if you calculate from this portion the net present value equal to positive $100, and then when you deduct the flotation cost out of it, that may be $150, so the net present value would become minus $50. So the impact of flotation cost is that a project which was otherwise acceptable, it may not be acceptable anymore, and then the effect is that it reduces the net present value of the project. And the other method is to adjustment to discount rate. It means the subtract the flotation cost from the proceeds of the security and recalculate yield figures. For example, आपने जो security sell की है, suppose there is a bond and the face value of the bond is $1,000 and the rate on it is 10%. And the firm has to pay an expense of $100 every year, but if because of the flotation cost, जो sale proceeds of this bond is, that is 1,000 minus the flotation cost, let's suppose it is $50, and now we have the sale proceeds of that security equal to 950, whereas we are going to pay $100 as an expense. So in that case, yield figure should be revised. So what it would become? It should become like this. It will be more than 10%. So in this case, yield would become more than 10%. So effectively, the cost of the capital has increased more than the stated cost of capital. So its impact is it increases the cost for any capital component with flotation cost. And when we increase the cost of capital, it means कि अब हमारे पास जो net present value है, that should be less. It might go to negative as well. So it increases the weighted average cost, and which decreases the net present value. So its result is that it increases the weighted average cost, and it ultimately the net present value is also decreased. And the next concept is economic value addition. So it means a specific measure developed by Stern Stewart and Company in late 80s. The Stern Stewart and Company, they developed this measure, and it is known as economic value added. They determine that how much value is added to the firm after payment of all the liabilities and expenses, and it is a measure of business performance, and it is another way of measuring that firms are earning returns on their invested capital that exceeds their cost of capital. And let's see how they perform it. And we can calculate the economic value added by using this formula, that is net operating profit after tax, and then we deduct out of it the cost of capital into capital employed. So cost of capital, what we have, the cost for that particular capital financing, and then since a cost is charged for equity capital also, a positive economic value added generally indicates the shareholders' value is being created. So if still we get anything positive here, it means this is the value addition into the firm's value, and it is based on the economic, not the accounting profits. And the net operating profit after tax is a company's potential after tax profit if it was all equity financed or unlevered. And you can see here, in this case, it is calculated for the companies where the total financing is out of equity financing and it is not levered. That levered would mean कि उसमें debt financing का portion नहीं है. But if the debt financing portion is there, it means कि it should be handled before we calculate the net operating profit after tax. And now we will be discussing the determining project specific required rates of return, and how we do it. We use Kappa in the project selection, and we have to perform these functions. That is, initially assume that all the financing comes from the equity financing, and determine project beta. Project beta के बारे में हमने पहले से भी डिस्कस किया था कि we calculate the project beta by dividing the excess returns of the firm by the excess returns of the portfolio in the market, and then calculate the expected return, adjust for capital structure of the firm, and compare cost to the internal rate of return of the project. And when you are going to solve problems of this nature, most of the information will be given to you. That is, you will be having the information of beta, you will be having the risk-free return, you will be having the expected market return, and then you will calculate the required rate of return, making all the calculations given in the Kappa model, and then you will compare it with the internal rate of return. So if it is acceptable, only then the project would be accepted, and if it is more than the internal rate of return, it means that the net present value of the firm is negative. In that case, the project will not be accepted anymore. And there are certain difficulties while calculating the project specific required rate of return, because when we calculate the security market line, so we have to determine a proxy. So to locate a proxy for the project is much easier if assets are traded. अगर किसी firm के assets जो हैं which are being traded into the market, then the information is available. और अगर the stocks or the assets they are not being traded into the market, the information is not available for that particular project. So to locate a proxy will be very much difficult. So there are different firms which are providing the information about the proxies and information about the betas. So we can hire the services of those firms and then plot the characteristics line relationship between the market portfolio and the proxy asset excess returns. So then we plot a relationship between the market portfolio and proxy asset excess returns, and then estimate beta and create the security market line. And when you have drawn the security market line and then plot your own project specific required rate of returns on the same graph, and you will see your projects will be lying above or down that security market line. So जो भी project इस security market line से ऊपर lie करते हैं, it means they can be accepted, and the projects which lie below the security market line, that should be rejected. And you can see here the risk free rate is given here. So even though the projects, some of the projects will be even lower than the security risk free rate of return, so their rate of return is even lower than the risk free rate of return. So in that case they should be definitely rejected. And another measure next to that is the security market line. So all those projects which lie below the security market line, they should also be rejected. And the projects which lie above the security market line, it means they can earn returns more than the market portfolio for that particular project. So in that case you can accept all the projects which lie above the security market line. And now how do we determine the project specific required rate of return? We use the Kappa model, and we use this equation, that is required rate of return will be equal to the risk free rate plus the expected rate of return in the market minus the risk free rate into beta for that particular project. And you make adjustment for capital structure of the firm, that is financing weights. And when you have calculated the required rate of return for a particular project, then you calculate the weighted average required rate of return. It means the portion of financing which comes from debt in the total capital required for that project, and then assign it the cost for that debt, that is KI, that is after tax cost of debt, and required rate of return in case of equity, which we calculated using Kappa model, and percentage of equity in total financing, and then we get the weighted average cost of and then we get weighted average required rate of return. We can elaborate the idea with this example, and it will be quite simple. And assume that a computer networking project is being considered with an internal rate of return of 19%, and examination of firms in the networking industry allows us to estimate an all equity beta of 1.5%. So when we locate the proxy for our firm in the market, and based on the information we calculate the beta, that is equal to 1.5%, and this information can be provided by the specific organizations, or even by yourself. You can take the returns of that particular proxy firm and the returns of that market portfolio, and you can calculate the beta for that proxy firm. And our firm is financed with 70% of equity and 30% of debt, that is cost of debt given as 6%. The expected return on the market is 11.2% and the risk free rate is 4%. अब हमने इसमें प्रोजेक्ट के लिए required rate of return find करना है. And in this case, whatever problems you solve, that will be given at the end. उसमें most of the information will be given, and you have to simply put all the information in the equation, and you can solve for the required objective. And in this case, we have to solve for the required rate of return. So let's put all the information in the Kappa model. So we have to calculate the required rate of return of equity, and here we are given risk-free rate, that is 4%, and expected return in the market is 11.2%, and we subtract from it the 4% risk-free rate and multiply it with the beta, that the information is also given in the example, and we solve for it. We get 14.8%. Now this 14.8% is for the financing portion, which is 70%. अब इसमें हम इसको वेटेड एवरेज कास्ट ऑफ कैपिटल जब फाइंड आउट करेंगे तो 70% से इस कास्ट को मल्टीप्लाई करेंगे, एंड देन हमारे पास 30% फाइनेंसिंग है आउट ऑफ डेट, और उसके लिए कास्ट गिवन है, दैट इज 6%, एंड वी मल्टीप्लाई इट and we solve for it, और हमारे पास weighted average cost of capital है 12.16%. अब internal rate of return which is given as 19%, which is greater than the weighted average cost of capital which is 12.16%. So in this case, if you look in the profile, net present value profile, you can see here the net present value, it becomes zero at internal rate of return at this point. So this is 19%, and now we calculated internal rate of return which is 12.16%. So in this case we have a net present value which is positive figure, so the project should be accepted. In previous slides हमने कैलकुलेट किया है प्रोजेक्ट स्पेसिफिक रिक्वायर्ड रेट ऑफ रिटर्न, जिसमें हमारे पास Kappa मॉडल गिवन है और उसमें ऑल द इंफॉर्मेशन वी विल बी गिवन एंड वी कैलकुलेट द रिक्वायर्ड रेट ऑफ रिटर्न. अब उसको हम कंपेयर करेंगे अपने इंटरनल रेट ऑफ रिटर्न से. इफ इट इज less than the internal rate of return, it means the net present value is positive, the project can be accepted. And now we are going to determine the group specific required rate of return. And likewise, as in the case of project specific required rate of return, हम group specific required rate of return में भी Kappa model यूज करेंगे, और इसके अंदर initially we assume again that it is all equity financed, and we determine the group beta and calculate the expected return, that is information what should be available, that is the beta, the market rate of return expected, and adjust for capital structure of the firm. उसके बाद हम capital structure firm के लिए उसको adjust करेंगे, and after determining the beta we calculate the expected return for that project and adjust for capital structure of the group, that is how much is out of debt and how much percentage is out of equity financing, and then we compare the cost of internal rate of return with the cost we determined, that is as a group specific required rate of return. And if the group specific required rate of return is less than the internal rate of return, we go for that project. And now we compare the group specific required rates of return with the company's cost of capital. So we draw between the beta and the expected rate of return. So as we keep on increasing the beta, and we have the expected rate of return here. So for the projects, so these are the group specific rate of return, they are expressed as a bar here, and we have a dotted line which represents the company cost of capital. अब जो वो projects, वो groups where the required rate of return is more than the cost of the capital, that should be accepted, and where the group specific required rate of return is less than the cost of capital, it means the company should abandon those projects. And then the next concept is about the project evaluation based on total risk. Sometimes किसी भी project में apparently when we make our calculations we get a different level of risk, we determine a different level of risk, लेकिन there is in your mind or based on the experience you use intuition कि इसके अंदर risk ज़्यादा हो सकता है, and we use here the risk adjusted discount rate approach, that is the required rate is increased or decreased relative to the firm's overall cost of capital for projects or groups showing greater or smaller than average risk. इसमें projects के साथ जो risk associated हैं, अगर that is perceived to be higher, उसमें required rate of return can be adjusted accordingly, and if the risk is lower, then again the required rate of return would be adjusted accordingly. So the advantages of risk adjusted discount rate is that it is simple and can be easily understood. It has a great deal of intuitive appeal for risk averse managers. अब वो managers जो risk taker नहीं हैं, they are risk averse. So after calculating the required rate of return and still feel there is a risk in the project, then they have to add another premiums in the required rate of return, and it incorporates an attitude towards uncertainty. अब इसमें जो managers का attitude है towards the uncertainty, that is also incorporated here. Besides the calculations they make based on different models, they use their own intuition and they can add or they can reduce the required rate of return. Now we can explain the concept of risk adjusted discount rate using the net present value for file. इसको हमने previous slides में discuss किया था in our previous lectures कि we have this net present value for file जिसमें for different discount rates we have different net present values. इसमें वो value जहाँ पे net present value is equal to 0 उस discount rate को हम internal rate of return कहते हैं. When we talk of risk adjusted discount rate, suppose कि firm ने risk adjusted discount rate determine किया था 12% at this level, and at this point the net present value goes negative, and based on this perception of low risk, the discount rate can be moved from this point to 10% point. So when it comes at 10%, it means the net present value goes positive here at this level, so the project can be accepted. And if the required rate of return or the discount rate was determined suppose at 9%, लेकिन उसके साथ different risks जो हैं that they are also associated with that project, and now the firm or the managers they adjust the risk from 9% to 15%. So in that case the net present value at 15% goes below 0, that is negative. So at this point, so it means the project will be rejected. The project will not be accepted. And now the project evaluation based on total risk. So we have the probability distribution approach here. We use the net present value and the standard deviation and we plot it on a graph, and then we decide based on that information. So the standard deviation actually is the risk. So we take the probability distribution and we will be using the information like coefficient of variation and standard deviation. So in this case, we see that we plot a graph between the standard deviation and the expected value of the net present value, and we plot them and we have different points for different projects. You can see here the project A, B and C for example. अब इसमें firms के जो managers हैं they have their approach towards the risk. अगर तो firm की management जो है that is a risk averse, it will go for the projects with minimum standard deviation values. So in this case if you see the projects they have charted on this graph using the standard deviation information and the expected value of net present value. So you can see here these curves they represent the indifference curves. Any project which lies on these firms, the managers will accept that project. So if you see here project A has the minimum standard deviation, it means it has minimum risk in all the given projects. So this lies on the indifference curve. The management will accept project A, and if the management can take a moderate risk, it will the indifference curve will take the shape like this, and any project which lies on these curves and the firm will accept that project. So in this case the firm has moved from here, that is the standard deviation of project A, and they are going to take a little more risk, the standard deviation of project B, with the return available at this point is this. So the firm is going to take a little higher risk, and the high risk would earn a little high return as well. अब इस project B के नीचे you can see the point, this point also lies almost on the same line, but for this point the return is quite less. So the firm would go for project B, and if the management can take the risk in the hope to earn some high returns, so you can see here the standard deviation for point A is here, for point B is here, and for point C the standard deviation or the risk involved is at this point. So the firm is ready to take maximum of risk, and this will determine the indifference curve, that every project which lies on this indifference curve firm would accept that project, and this will determine the net present value for the firm. So this will the probability distribution approach determines based on the risk and the what is the attitude of the management, कि management जो है वो risk averse है या management moderate risk लेती है या management can take high levels of risk, and based on the level of risk the firm can earn different levels of returns. So for the high risk projects the returns can be higher, and for the low risk projects the returns would be lower. And how do we adjust beta for a financial leverage? You simply keep in mind this information when you have to adjust beta for any given problem. You have to solve it like this. You adjust for the beta for project J by using this information where beta J is for a levered firm and beta JU represents beta of an unlevered firm, that is an all equity financed firm, and B over S, it represents the debt to equity ratio in the market terms, and TC is the corporate tax rate. So if you solve for this equation to calculate the adjusted beta, so you can calculate it for the project J by using this information. And what is adjusted present value? Adjusted present value is the sum of the discounted value of the project's operating cash flow plus the value of any tax shield benefits of the interest associated with the project's financing minus any flotation cost. When we calculate the adjusted present value, तो इसमें हम सबसे पहले क्या करते हैं कि we calculate the net present value of unlevered project value. That is, हम suppose करते हैं कि the project is all financed with equity and we calculate the net present value for that, and then we calculate the value of project financing. अब project financing में क्या कुछ involved है? There can be another portion, that is the tax proportion out of tax financing, and we have flotation cost as well. So when we adjust for the flotation cost and the interest rates paid over the debt financing, then we calculate the adjusted present value, and then based on the adjusted present value, the management would decide to accept or reject a project. So the example for the adjusted present value is, assume AB Corporation is considering a new $425,000 automated machine which will save the firm $100 per year for the next 6 years. The required rate of return on unlevered equity is 11%. That is, required rate of return on equity financing is 11%. And ABC can borrow $180,000 at 7% with $10,000 after tax flotation cost. The principal is repaid at $30,000 per year plus interest. The firm is in the 40% tax bracket. Now what we have to do is, first of all, we have to calculate the net present value using this information and this given rate, and then we will adjust it using the interest rate benefits and the cash outflow, the flotation cost. And first of all, we calculate the net present value, that is, using this project we can save $100,000 annually. This will take the form of an annuity, and we use the table 4 to get the present value interest factor for 11% for the 6 years minus the initial cash outlay, that is $425,000, and we get a net present value which is a negative figure here, that is minus $1,946. And based on this information, the project can be rejected, but there is another option to arrange $180,000 out of debt financing, and the rate for debt financing is 7%, and we first calculate how much interest is going to be paid over the next 6 years, and we calculate the interest rate that is going to be paid over the next 6 years. And for the first year, the interest rate is on the principal of $180,000. The 7% of this amount is $12,600, and after that, the principal out of the principal amount $30,000 is paid every year. अब next year का जो balance है, that is $150,000 after payment of the first installment, and then the interest rate for the second year is $10,500, और again third year का जो balance होगा, that will be after payment of $30,000 installment. So the interest will be charged on $120,000. It will become $84,000, and gradually for the final year's balance, that is $30,000, the interest will be charged $2,100. And these are the interest expenses the firm would be paying over the next 6 years. अब इसके against, as you know, this is a tax deductible expense. Interest expense जो है, that is tax deductible expense, और इसके against there are some tax benefits. So now we calculate that tax benefit. So you can see here the tax shield benefit for the first year is we have the tax rate equal to 40%. So इसमें tax shield benefit जो है that is for the first year 40% of the interest payment, that is $5,040, and gradually we calculate for all the years. So these are the tax savings in fact. So we calculate the present value of all these values, that is it is for the year 1, this is at the end of year 1, and now this is at the end of year 2, this is at the end of year 3, and the 4, 5, and at the end of year 6. So we calculate the present values using the same discount rate, that is 11% for the years 1, 2, 3, 4, 5 and 6. अब आप इसकी present value find out कर सकते हैं using table 2. उसमें 11% के नीचे आप for the period 1, 2, 3, 4, 5 or 6, if you look at for the values, you can see for the first year, second year, third year. So these are the present value interest factors, and you will multiply it with the tax shield benefits, and we get the present value of the tax shield benefits for the 6 years. So this is the present value of the tax shield benefits, $13,513, and the flotation cost was $10,000. अब हमने initially जो net present value find out की थी, that was a negative 1,946, and then we add the present value of the tax shield benefits and minus the flotation cost. So we get an adjusted present value, that is $1,567. So you can see here that using the adjusted present value technique, the project becomes acceptable. If you use only the net present value and keep the project as unlevered, that is 100% is financed out of the equity financing, that is after sharing issues, that is the project is all equity financed, the net present value is negative and the project can be rejected. But if you introduce the net financing portion into it and you calculate the tax benefits and their present value, the project becomes acceptable. And now we are going to solve few of the problems given at the end of the chapter. So problem number 1 states that Zapata Enterprises is financed by two sources of funds, that is bonds and common stock. The cost of capital for funds provided by bonds is KI, as you can see here, KI, and KE is the cost of capital for equity. So these are the symbols we have been using very often, and KD is also one of the symbols we use, and these are the cost of capitals. So the capital structure consists of B dollars worth of bonds and S dollars worth of stock. So the capital structure includes bonds and stocks, and bond is represented with B and stock is represented with S. So where the amounts represent market values, compute the overall weighted average of cost of capital. It is represented as K naught. So we have to find out weighted average cost of capital in this case. So first of all, what we are supposed to do is that in total capital structure, that includes bonds plus stocks, that is B plus S, and then we apply required cost of capital structure. So this is the solution of this problem, that is bonds, they are represented as KI, you can see here, and the common stock, cost of common stock is represented as KE. So how do we calculate the proportion of total financing, that is B is the value of bond in total capital structure, that is B plus S, B over B plus S, and then the weighted average cost is कि हमारे पास जो cost of capital given है for bond, हम उसको multiply करेंगे the weight of bond in the total capital structure, and accordingly हमारे पास cost of common stock है, that is represented as KE, और common stock का proportion total capital structure में क्या है, total capital structure is represented with B plus S, and then the proportion of stock in B plus S is S over B plus S. It will give us the proportionate figure of the stock in the total capital structure. और अब हमने इसकी weighted cost जब calculate करनी है, then we have to multiply the KE, which is cost of common stock, with the proportion of the stock in the total capital structure, and then we will add them up. so this will make up the 100% of the capital structure, and then we add the both of these weighted values, that is ki into b over b plus s plus ke into s over b plus s. So this will give us k naught. So k naught is equal to k1 into b over b plus s plus ke into s over b plus s. अब हम इसमें से b plus s को कॉमन ले सकते हैं, and when we take it as common, so that we can write the equation alternately like this: ki into b, then ke into s divided by the total capital structure. हम इसको सिंप्लीफाइड तरीके से भी सॉल्व कर सकते हैं कि हमारे पास जो कॉस्ट ऑफ बॉन्ड है उसको हम बॉन्ड की वर्थ के साथ मल्टीप्लाई कर दें, एंड देन हमारे पास जो कॉस्ट ऑफ कॉमन स्टॉक है हम उसको कॉमन स्टॉक की वर्थ के साथ मल्टीप्लाई करके इस वैल्यू को, इस एडेड वैल्यू को हम टोटल कैपिटल स्ट्रक्चर की जो वैल्यू है उससे डिवाइड करें, देन वी कैन गेट द के नॉट विच वाज द वेटेड एवरेज कॉस्ट ऑफ द कैपिटल. And now let's go towards the problem number 2. It states that assume that B, that is bond, in the value of the bond in the total capital structure in problem number 1 is $3 billion, and S, which is the stock, it is $7 million. The bonds have a 14% yield to maturity, and the stock is expected to pay $500,000 in dividends. So the dividends for the year, they will be paid as $500,000 for the year, and the growth rate of dividend has been 11%, what we represent as G, and is expected to continue at the same rate. Find the cost of capital if the corporation tax rate of income is 40%. So what we have to determine is the cost of capital given the interest rate of 14%. So here we have to calculate the return on bonds after tax. So we apply the tax rate on the bond, then it will be represented as KI, and KD is the return on the bonds, and 1 minus T is the tax rate. So 14% was the return, and then 1 minus 40%, that is 1 minus 0.4, it will give us 0.6. So after tax return would be 8.4%, and then we determine the cost of common stock I'm sorry, and then से दोबारा continue करूँगा, and then we calculate the return on common stock, and we know the formula for this purpose, that is KE is equal to D1, that is the dividend, divided by P naught plus G. So you must be aware that the dividends, it is equal to the number of share into D1, that is the rate of the dividend, divided by number of shares into the price of one share plus G. So here we are given the value of dividend, that is 500,000, and the worth of the stock is $7 million plus 11% is the growth rate. So we solve for it. By solving this part, we get 0.0174 plus 0.11, and we get a return equal to 18.14% or 18.14%, and we calculate the weighted average cost of capital, or K naught. It is equal to after tax required rate of return, that is KI, into the proportion of the bond in the total capital structure, that is B over B plus S, जैसा हमने पिछली स्लाइड में कैलकुलेट किया था. अब हमारे पास B की वैल्यू भी गिवन है और टोटल कैपिटल स्ट्रक्चर भी, उसमें टोटल वैल्यू जो कैपिटल की है वो भी गिवन है, प्लस KE, that is required rate of return on the common stock, into S over B plus S. S जो है वो स्टॉक की वर्थ है डिवाइडेड बाय द टोटल कैपिटल स्ट्रक्चर. अब हमने ये KI कैलकुलेट किया था, दैट इज आफ्टर टैक्स रेट ऑफ रिटर्न 0.084 into 3 million जो वर्थ है, दैट इज द वर्थ ऑफ द बॉन्ड्स, और टोटल कैपिटल है 10 million, प्लस 0.1814, that is 18.14%, into 7 million, that is the worth of the stock, divided by the total capital, that is $10 million. And when we solve for it, we get the weighted average cost of capital or weighted average required rate of return equal to 15.22%. And now let's see the problem number 3. It says on January 1st, let's say 2011, International Copy Machine, one of the favorites of the stock market, was priced at $300 per share. It was quite popular in the market and the demand was quite higher, and the price per share was $300. This price was based on an expected dividend at the end of the year of $3 per share, and at that time expected dividend was $3 per share, and expected annual growth rate is in dividend is 20%, or dividend ka growth rate, that is we represent it as G, it is given as 20%. By January 2011, or let's say 2011-12, or the next year, economic indicators have turned down and investors have revised their estimate for future dividend growth of ICOM downward to 15%. And because of the poor performance, the economic indicators they turned down, and investors they revised their estimate for future dividend growth of ICOM downward to 15%. So instead of 20% growth, अब उसमें dividend growth जो है वो 15% होगी. So what should be the price of the firm's common stock in January 2012? Let's say 2012. Assume the following. So we have the following assumptions. First of all, a constant dividend growth valuation model is a reasonable representation of the way the market values ICOM. So we use the constant dividend growth model, and then the firm does not change the risk complexion of its assets nor its financial leverage. The expected dividend at the end of 2012 is $3.14 per share. So what will be the next year's return or the dividend that was paid on the stocks? So we can see here the cost of capital or return, it is because of the constant growth model. We can use this formula and we put the value, that is the dividend paid at 2011. Let's suppose this is 2011. So in this case, the dividend paid was $3 divided by the value of the share or the price of the share in the market plus G, that is constant growth rate of the dividends. So if we solve for it, we get a figure of 21%. And after 1 year, what happens is the dividend paid will be $3.45, whereas by using the same equation and rearranging it, we get the price of the share, it is equal to D1 divided by KE minus G. So we have a KE equal to 0.21%, 21% equal to 0.21 minus 0.15, that is the new growth rate of the stocks, of the dividend. And we solve for it and we get the value of the share equal to $57.5. So there is a huge decline in the price of the share. I advise you to solve the problems given at the end of this chapter. The solutions will be provided to you. They are quite simple problems, and keep in mind that this will not be part of your exam. Your exam will be out of this 15th chapter. The problems given at the end of the chapter, you solve them for your practice, but that will not be part of your exams or any type of quizzes. So I will highly recommend you to solve those problems. The solutions will be provided to you. And that was all about today's lecture. Now let's have a look. What did we study in our today's lecture? We discussed the firm's weighted average cost of capital and understand its rationale, use and limitations. And also we discussed the concept of economic value added and how it is related to value creation and the firm's cost of capital. And also we tried to understand the capital asset pricing model's role in computing project specific and group specific required rates of return. And also in the end, we discussed the adjusted present value and we solved a problem also related to the adjusted present value. And this is all for today's lecture. Inshallah, see you in the next lecture. Till then, Assalamu alaikum.